Hi, and welcome back, everyone, to Tactical Portfolio Update. My name is Michael LeBlanc, Senior Portfolio Manager at Canaccord Genuity Wealth Management and Partner at LLC Private Wealth. Thanks for joining us today for our live update where we talk about everything that's going on in the portfolios, what we've seen in the market this week, and what we see coming up. So thanks for joining us. As always, if you want to get a replay of this or any other episode, you can go to mikeonmoney.com. That's our portal where you can access those. Also the podcast, in case you want to listen to these on the run, you can access all that through there. And do send us any questions or ideas that you have that you might want us to address in these, or specific topics that you want us to cover. But with that, let's jump into what's going on in the markets. Obviously, November's had a great start to the month as far as the market performance goes, with a bit of bounce off the bottom, or the more recent bottom, I should say. No one knows where that's going to settle, but the start of November has been strong, mostly fueled by pretty strong or better than expected inflation numbers coming out. Both Canada and the U.S. Showing a big drop in the inflation rates, which is really what we're trying to do with all these interest rate hikes, is bring the inflation numbers down. We're still not in a range that we're probably going to see the end of the hikes, but certainly some signaling that the rate hikes might slow and that inflation might come under control. Keeping in mind that the central bank's target is to get below 3% on the inflation numbers. We had a slow start to the markets yesterday with a down day for Monday. Things have bounced up again today. Today's mostly being fueled by some optimistic numbers coming out of China that were again a bit better than expected. So the trend is still kind of headed up there, but I wouldn't say that we're out of the woods. Like we still have at the end of the year, we're still going to see some volatility. We're still going to see those down days, the pullback days. But if you've been following the portfolio, you'll notice that a few weeks ago, or just over 2 weeks ago, we did deploy about 10% of we had of the cash available. So we had 30% in cash. We've dropped that just below 20%, sitting around 19% cash in the portfolio that we deployed into the market. So we've taken a good chunk, taking the money, taking advantage of this recent uptick that we've seen off the recent lows. And we're going to continue to try to find those types of opportunities in the next couple of months here, as we continue to see some volatility for the end of the year. We are still looking forward to a better year in the new year, and other changes we made in the portfolios, certainly on the bond market. We made a shift in there. If you saw a change, we had a portfolio of bonds that was targeted on very short duration. We moved to a much more tactical strategy there, looking to take advantage of the slowing interest rate hikes, but also maybe some cuts in the new year. And we want to be able to be very dynamic. So moving from a static strategy to a dynamic strategy as we make the shift from rising interest rates to slowing and potentially some cuts coming down the road. Basically, we're still looking at pretty good outlook. I mean, if you look at the U.S. dollar, which is pretty much an indicator of sentiment. So when people are negative, there's a flight to safety. So we see the U.S. dollar rally up. The U.S. dollar's hit a 3-month low as people have been selling off the U.S. dollar in favor of equities and other currencies. So the Canadian dollar has strengthened a bit, as well as most other international currencies, as the U.S. dollar has come off its highs there. On the bond front, as I mentioned, things are starting to shape up there. We actually see the bond market leveling off a little bit, basically saying that the risk of future hikes is basically priced in. The bond market is starting to finally believe that the U.S. Fed, as far as what interest rate hikes are going to look like and how they're going to play out. So that's good news for the bond portfolios that we do have in there, where they've been really low volume. So the market prices were off a little bit, even though they've been paying us really well and continue to pay us very handsomely, a couple of them over 9%. That's going to continue, but hopefully we'll see strength in those valuations as well, as the bond market stabilizes and starts to pick up going into the end of this year. As far as energy goes, oil price is a little bit off yesterday, but been rallying over the last couple of weeks, along with everything else. Kind of as we looked at going into the U.S. election, that we would start to see strength in the oil prices. There's still a little bit of weakness around oil prices as Russia seems to be able to continue to find markets for its oil, even increasing some of its production. Still finding homes for it, despite the Western countries kind of boycotting it with their sanctions. But the price still has been showing a lot of strength, and we'll stay on that seasonal trade for a little bit longer, where we increased our energy exposures going into the election, and now taking advantage of the jumps that we've seen after the elections. As far as the elections go, obviously a good showing for the Democrats. It was pretty much expected, based on polls and historic numbers, that the non-sitting party tends to take control of the House and the Senate by a pretty decent majority. That didn't happen. In fact, it looks like the Democrats have maintained control of the Senate. They may even gain a seat depending on a couple of these runoff elections. Congress looks like it's going to go to Republican, but a very thin majority. So not the big swing that everyone was expecting, and the market likes that. So now we've kind of handcuffed the U.S. market, or sorry, the U.S. government from too much extra spending. Neither one party can really drive through any big initiatives, given that the Congress and the Senate being opposed, and of course the Biden presidency. So all that's going to just slow down some of the spending and things that the government can do. Pretty normal in the last 2 years of a term for President Obama. Faced the same thing when he was there. So markets like that, no big spends, so the outlook is pretty strong. On the metals front, gold continues to gain some ground. Completely against intuition here. Gold should have been going up with inflation. It did not. In fact, it had gone down. So it's been on the rise over the last month or so. Getting just above 1,700 an ounce. Still not over its 1,800 an ounce where it was about a year and a half ago. So that continues to move with strength as things kind of return to normal. In the markets, we're continuing to see a lot of M&A. Big one out there right now. Estee Lauder is near a deal to buy out Tom Ford. So that's been going on with about 2.8 billion, going back and forth with a little bit of competition around that purchase. And also, if you've been following cryptocurrency, I'm not going to dive into crypto. I've done some individual videos on crypto to talk about trading and the different types, and when or why you might want to buy cryptocurrencies, and also cautioning on using it as an investment. So it carries risk just like any other investment, and one of the biggest ones is regulatory, and that's what we've seen in 2022. A lot of problems around the regulatory front. We've seen a lot of straight up scams, rug pulls, people losing their money to fraud. To the more recent, bankruptcy of one of the big trading platforms, FTX, where they had over leveraged their assets. So basically, they were holding about 8 billion in crypto assets, and they leveraged that to invest in other things. And that leverage side fell apart. In fact, in the end of the 8 billion, they only had about 1 billion in cash compared to 8 billion in liabilities. So not good for anyone who had any money on that platform, which includes the Canadian pension plan. Had about just over 90 million in there. Not a big number for the overall portfolio, but still a significant loss. In fact, the FTX just named a new CEO, John Ray III, if you're familiar with that name. He went in and cleaned up Enron, Nortels, and several others when they went into creditor protection, trying to find assets for the creditors or people that are due. It's not looking good on that front as far as recovering too many assets, but that's been another kind of just another hit against the valuations of the cryptocurrencies this year. So if you're playing in that, do reach out to us if you have any questions. We're happy to try to answer them, guide you as best we can, and certainly if you're thinking of investing into crypto, do your due diligence or reach out to us. We're happy to discuss the different types, why you might want to use it as an investment, and also understanding the risks behind those investments. If you've been a traveler, so now I'll caveat with we don't have any airline carriers in the portfolio right now. It's actually not a sector we tend to focus on, simply because it is fraught with losses. I think Warren Buffett said it best when he said, if you put all the airline carriers together since Kitty Hawk, they've not made money. As a whole, there's been individual opportunities, I guess, in that sector, but it's been tough. Well, they just got a big fine required to pay millions due to too many flight cancellations and delay in refunding people for those. So if you've experienced that recently, at least you know they've got their hands slapped, having to pay over 200 million in fines as the transportation department cracks down on that practice. And hopefully we'll see some improvement with that as things move forward. China's economy takes a bit of a deeper hit on the retail side. So retail spending, I think that's going to be a general theme you're going to hear through, especially through the holiday season, since retail sales is a big number that everyone looks at. Certainly on the luxury items or kind of the consumer discretionaries, I think the staples are going to do fine. I think the lower, the discount sellers are going to do well. In fact, if you look in the portfolio, we have Dollarama in there, just taking advantage of that trend this year. I think people are just going to tighten their wallets a little bit going into the holiday season, avoiding the big brand names and avoiding the big ticket items, as very cautious about where the economy is going. As I mentioned, still looking at a volatile fall here, still more rate hikes to come. And of course, that recession name or the recession word that's still being thrown around. Again, our view is pretty much we're in a recession. Recession is a backwards looking indicator. So you don't know if you're in a recession till you're about 9 months into one. And our view is by the time they actually declare a recession, we'll either be very close to coming out of it or already starting to come out of it. So I wouldn't be afraid of that word. Obviously it's going to have an impact. The next big thing we're looking at is employment rates. And if you've been watching the news lately, obviously a lot of layoffs happen, especially in the tech sector, but in a lot of sectors, quietly big numbers being let off everywhere. And I think you're going to start to see that unemployment number start to rise, both here in Canada and the US. And that's kind of the last turning point for both the recession and also inflation to turn over, because obviously with job uncertainty, hidden in larger numbers, people will spend less, drives prices down. So we'll keep an eye on that as that continues to play out over the next little while. Obviously, we're still watching things in Ukraine, some headway being made there with some retreats from Russia, but far from being resolved. So continues to see those problems, as I mentioned, even around the oil prices, as Russia's increase in their output through kind of backdoor sales, going around the sanctions that are in place from the Western countries, and that pretty much is continued to move along. There was also, when we talk about energy, there was also a deal made at the G20, basically to commit $20 billion to kind of wean Indonesia, off of coal. So just still that global trend moving to alternative fuels, cleaner fuels. And that's a theme we've talked about for a long time. There's a lot of opportunity as that happens, but I will again caution, and you'll see that in the portfolios, where it's not a switch. It's not something where companies can just flip the switch and go to alternatives. Infrastructure has got to be built up. The capacities have to be built up, and that's going to take years. So really, when we're looking at those opportunities, as we always say, we don't always if we like gold, we don't always go out and buy gold. We'll go out and invest in pickaxes, because that's kind of the service side of the theme is kind of where we see the safer or more stable growth, and that's where we'll focus on the alternative energy space, and especially when we talk about vehicles and the shift over to more electric or lower polluted vehicles over the next little while. So we're seeing a little bit of more earnings coming out, but the big earnings season is pretty much over until the fourth quarter. As I mentioned, look for some slower numbers. Look for earnings hits over the next little while. Pretty much still going to be some negative news. Most of that is priced into the market already. Well, as I mentioned, we're still going to see some of that volatility, some of that negativity. But overall, we continue to see optimistic outlook going into the fourth quarter as far as taking advantage of these pullbacks. So with that, I'll leave you. If you have any questions, do reach out to us. Other than that, we're going to go to a weekly format for these portfolio updates. So every Tuesday at noon, you can tune in or go, as I mentioned, go to our portal, Mike on Money, and you can catch the replays at your leisure and stay on top of what's going on in the portfolios. Thanks very much, everyone. Take care and enjoy.